Good afternoon. Welcome to the Gatewood Wealth Solutions weekly market commentary broadcast. This is John Gatewood, and with me today is our Chief Investment Officer, Aaron Tuttle.
John, I'm glad to be here.
Well, I'm glad you're here too. Boy, what a week we have had, and our hearts go out to George Floyd's family and all those who suffer racism from the few who do not represent our country's liberty and equality for all people. And while the media has focused on the senseless violence harming innocent people and businesses, we see many more news clippings about heroes who are standing up in the right way for change. Former President George W. Bush issued a statement Tuesday on the protests saying he and his wife Laura are anguished by the brutal suffocation of George Floyd and disturbed by the injustice and fear that suffocate our country. The heroes of America, he says, from Frederick Douglass to Harriet Tubman to Abraham Lincoln to Martin Luther King, are heroes of unity. And Mr. Bush also said, we can only see the reality of America's need by seeing it through the eyes of threatened, oppressed, or disenfranchised. But another quote that I saw was Citigroup's chief financial officer, Mark Mason, also an African American, wrote in a blog post that he realized he had to address the situation. He said, even though I'm the CFO of a global bank, the killings of George Floyd in Minnesota, Ahmaud Arbery in Georgia, and Breonna Taylor in Kentucky are reminders of the dangers Black Americans like me, he says, face in living our daily lives. But our job at Gatewood Wealth Solutions is not to judge these actions or any political response, but to understand what this means to our clients' portfolios. So just as many businesses were beginning to open up, having barely survived the COVID shutdown, many are now closed, damaged, or destroyed by looters. And despite all this, the market continues to inch up. Aaron, give us your thoughts on where we are.
Sure. Well, many of our listeners are familiar with reviewing our timeline where we like to start, and we continue to be delayed on removing all restrictions from the economy. So we were assuming at June 1st that we would have no restrictions on the economy. That clearly didn't happen, and with or without the current political environment, that just has not materialized. We do see signs of bottoming in the economy, and the virus seems to have abated. The daily death rate continues its downward trend. Yesterday was above 1,000, but we are having more days below 1,000 than above at this point. We can see that downward trend in the data. The CDC still shows that peak in mid-April with a total now of 86,495 deaths reported. We did have a negative report last week on the New York Fed nowcast. This may be due to the current riots and curfews. Personal consumption was down negative 3.17% for the week, while personal income was actually up 0.15. Is this because people are not spending? That's where we think the change is coming from. But if so, this will become future spending because this is essentially an increase in the savings rate. So it'll eventually move the GDP number up. We're also seeing manufacturing shipments and new orders increasing, meaning shelves are also being restocked. I move the slide along to that part. There we go. Similar to the virus, though, on the shutdowns, rioting and curfews will slow the economic activity. In addition, vandalism and looting will destroy capital and or remove it from the economy. The $2.4 million in Rolexes that cannot be sold probably can't be used either because of how tight the serial numbers are on the Rolex. Same with the Apple phones and other components. But if these items are replaced, we should see a positive increase in economic activity. But This does not mean we are wealthier as a society. We can't go around destroying things and all of a sudden have a positive effect on the economy. What's happening is assets have to be transferred from other sectors. Let's say you had investments in an insurance company and those were creating products, but now you have to liquidate those investments, divert those assets to replace the items that would have been there. Yes, you still have, let's say, replacing the shoes, but at the expense of other investments that could have been made. So we may see that in economic activity, but that does not mean that the economy is actually wealthier because of that effect. However, we want to be careful to distinguish between riots and protests. We often are seeing these conflated in the media right now, and Gatewood Wealth Solutions recognizes protesting as a human right. This right specifically acknowledged in the First Amendment guarantees the rights of citizens to peaceably assemble and petition their government. Now, we believe both issues, the government lockdown and abuse by law enforcement, require a national discussion, and we support the peaceful petitions and believe action is needed. These rights should never be abridged. Despite the negative report on the GDP, we do see positives. I know there's a lot on this slide. I'll go through each one. Manufacturing PMI increased 1.6% in April to 43.1. Now, readings below 50 are still considered a contraction in the economy, but it is key that they're moving up. Remember, our call was that we would begin to bottom and find our way out of this deep hole. Construction spending was off last month, but we're actually $385.2 billion above last year's 4-month numbers. So if you look at that same time frame in 2019, we've actually spent more money in construction so far. Mortgage applications are up 6 weeks in a row, and this is a 54% increase from the previous month. Home prices were up in the most in 2 years. Though it's true that the number of sales or the number of houses that were sold are down, prices are increasing. So that gets back to our concern about the inflation theme as a risk. The yield curve spread is at its steepest since 2017. Well, what does that mean? Well, if banks can borrow at a lower rate and loan at a higher rate, that incentivizes them to loan. And we certainly saw that with Amazon as they were able to take advantage of the higher lending ability and borrow $10 billion at very low yields. This money will be used as an investment by the company, and it's going to go straight into the economy. In addition, we're seeing strong IPO action. What does that mean? Companies that are private that are going public. This happens because you can remove that IPO offer at any time. You only see them whenever markets are strong. So we are starting to see indications that we are moving into an economy that is beginning to recover. This week, a couple of well-respected investment banks changed their bearish view to a more bullish view. Jamie Dimon, CEO of JP Morgan, made a statement that may sound similar to ours that many of the listeners have heard through this entire downturn. He said, you could see a fairly rapid recovery. The government has been pretty responsive. Large companies have the wherewithal, and hopefully we're keeping these small ones alive, meaning small cap companies. Shortly after, Goldman Sachs made a similar statement. And we don't think it's that they were following up JP Morgan and just doing a copycat. They're just seeing data that's contradicting their original bearish statement. But they have now since removed their bearish 2,400 target on the S&P 500. And it's because of the monetary and fiscal policy that we have often pointed at whenever we said we believe the recovery will be a sharp recovery. In short, we're happy to have them join our camp. We continue to track a V-shaped recovery. And as we climb the wall of worry, and as you mentioned, John, there is plenty to worry about through this market for sure. The next level of resistance is 31.25, and that support is now at that 50-day moving average. So that's at about 3,004 as of yesterday. It'll obviously move each day as the average changes. Investment themes. We continue to maintain our investment theme, but we're actually moving from a favor U.S. large cap stance to moving in the direction of favoring a U.S. domestic stance or U.S. domestic exposure, meaning that small cap and mid cap exposure could be an overweight as well in client portfolios. So one question as we were preparing this slide is, well, what would move us out of that favors U.S. domestic markets? And really it's a declining trend in the dollar. There was a sell-off in the dollar last week as many currencies gained strength against the U.S. dollar. But we're really in a trading range, and relatively speaking, the currencies are what is called improving, not necessarily leading the dollar. So shifting towards small cap will also help offset the risk if the dollar is beginning a weak trend, because small cap companies tend to have all of their sales in the U.S. domestic market, so you won't get the effect that a declining dollar would, let's say if you were in U.S. large cap. It's not going to respond as well as international, but I think that's really the thing that we're paying attention to whenever we have a call like favoring the U.S. domestic market. So John, I think we're at question and answer. So I'm going to go ahead and turn that back over to you. Stop sharing, and we constantly are experimenting, so bear with me while we change the view so you guys can see us.
Back and forth.
There we go. Yes, sir.
Very good. Well, you know, one of the questions that we've talked about is, and we see in the news, you know, apart from the protests, is the fact that so many people close together, the risk of a new second wave. And so what are your thoughts on the potential economic and market impact should new cases spike to previous highs?
We don't think that is likely. We're in that seasonality period. There are a lot of people out. There were a lot of people out before with the other previous protests. And we've seen some relaxation in many states. And other than a minor uptick, but nothing like what we saw back in April. So at this point, we still don't see a second wave materializing in the data. So we don't think that it'll affect the market.
So let's say even if there is a second wave, one of the things that I was reading about today was that Dr. Anthony Fauci believes that there will be a vaccine available by the end of this year, and that by January or early 2021 that they could have 200 million vaccines available, assuming of course that they are viable. Do you think that's priced into the market, and that's one of the reasons why there might be some relief?
Yeah, I do believe it is, and if we go back to looking at Moderna, how it traded, and whenever there was a vaccine, that it rallied, it came in, so you need that probability, but then that tells me, because there was a change in price, that the market is trying to account for those things. So if we were to get certainty on that, you would see a lift in the market based on that certainty.
So there were two headlines that appeared in the Wall Street Journal today. And this has to do with the fact that we've been issuing so much debt. It says, Fed promised to buy bonds, but is finding few takers. That's one. The other is, Japan warns its banks about risky U.S. debt. Can you comment on this?
It's, I find some irony there on Japan talking about the risk of debt. Whenever you look at their debt to GDP ratio, they are certainly the most indebted nation.
2.5 times the U.S.
Right, but it gets back to a phrase that has been used since 2008. Right, it's the best worst house on the block type of thing. So I think there isn't a clean shirt in the closet. But I do think there's significant risk with the amount of debt that we're creating, but there's no risk of default regarding the Fed. So that when they're saying no takers, it means that no one wants to sell their bonds to the Fed, because the Fed isn't selling bonds into the market; they're buying bonds into the market. And that's not too surprising. Just the jawboning of the Fed that they can go out there, that we know that there's a ready market, will cause the bonds to appreciate in value. And if you are keeping the yield, where are you going to go? Why make that change, knowing that the Fed can backstop that debt? So that I don't find that surprising.
So now let's turn to some of the international markets, because we've had a lot of focus on the U.S., and of course we're tilted towards the U.S. Markets. So I'm going to ask you about several regions for your opinion on economic outlook and market effect of each. China, there seems to be an uptick in protectionism by the U.S. with China. The Senate moved to delist Chinese companies from the U.S. stock exchange, and there are plans to suspend Chinese airlines to and from the U.S. Trade tensions continue. Your thoughts?
Well, we also are no longer recognizing Hong Kong as a favored market in the U.S. I think that is a significant blow to China for being able to raise capital. We were talking in the investment committee yesterday, and if many of our listeners may not know, but Tao is a native from China, and there's been a lot of change. And
Tao is one of our
portfolio analysts, and we were talking about that. And they really are going away from the liberalization that got them to where they are. In addition, the removing Hong Kong as a favored treatment means that they don't have the access to capital. That's really their financial hub. Imagine taking the New York City out of the U.S. economy and what impact that would have. And so we do see a lot of problems. Now, when you look at the debt to GDP ratio in China, it doesn't look as bad as the U.S., but there's a lot of maneuvering and moving that down to the different provinces, so you'd have to actually go through there. In addition, 40% of their traded companies are state-owned companies that they continue to move resources in, probably in a way that is inefficient and wasteful. So we do see a lot of problems with China. Many calls ago, we said the 2020 was America's decade. Now, I know if you had a time machine, you probably would never select 2020 as the year to travel to. But we don't see the U.S. influence and dominance really being lost to China. We're not in the camp that China is about to surpass us. Could be wrong, but when we look at it, it seems more like in the 90s whenever Japan was going to own the entire world, and that didn't work out. There is a difference, though. The population of Japan is about a third the size of the U.S., so to overcome the U.S. from a productivity standpoint, they would have to be 3 times as productive just to catch up to the U.S. Per individual, where it's about 4 times in China. So they only have to be a quarter productive of the U.S. to have an economy that is actually larger than the U.S. So
very interesting. Australia, this is a country we haven't commented on much, but they are coming off a 28-year growth streak. In fact, I think that's the longest growth streak for an international country in the developed world. But it had its GDP shrink by 0.3% in the first quarter of this year before the pandemic. Of course, the coronavirus took a heavy toll, and its trade relations with China are fraying, and international travel to Australia has dropped significantly. Your thoughts?
Well, it wouldn't be surprising to see such a long bull run in Australia. Australia is a very commodity-heavy economy, and they are near China, and they've done a lot of trade with China. So while China was building up its infrastructure, was probably it was the largest buildup in the shortest amount of time ever. So it's not surprising to see that a commodity-based economy, or a very commodity-rich economy, I guess is a better way of saying it, that traded with China while they were going through that buildup, had a very strong economy with China. And now that China is kind of slowing down, that we would see a slowdown in Australia.
All right, Europe. You know, the coronavirus wreaked varying degrees of economic destruction by country. And certain countries were already struggling with too much government debt and an aging population. Brexit, of course, was weighing on the EU's future, but a new massive stimulus plan is being implemented. Your thoughts? So
the European Union is an experiment that it really hasn't turned out that well. You have a common currency, so it is a union, But there isn't a central or federal government like there is in the U.S. So you don't get a lot of cooperation. You don't have a specific. There's a lot of tension, let's say, between Germany, who is trying to be very thrifty, and then let's say Greece, which tries to spend, and now they can't use their currencies to try to manage the economy and continue to either spend or be thrifty. So there's a lot of difficulty with trying to manage the economy whenever the monetary policy and then governmental policy or fiscal policy are oftentimes not coordinated. So we don't, and there's a decentralization movement really that's happening across the globe. Europe is now actually having protests as well in the streets. So I think a lot of it there's certainly the incidents here, but it seems that it was a match in what was already a tinderbox because of the shutdown and the virus. So it's spilling over to Europe. So there are a lot of issues there politically. There's this move to decentralization as they really can't find a coordinated a common political narrative, let's say. So we're very bearish on Europe.
Did you maybe interpret that instead of being decentralization to more nationalism?
Yeah, well, that's a move away from globalization, and nationalism means that more power shifts to the individual states, as in the old term of the state, where what we call countries now. But it's not just in Europe. We see that trend happening across the globe here as well. All right, there was not a unified response to the shutdown. There was a lot of authority by each state governor. And there still is now whenever we're dealing with the riots. So we've seen a decentralization or kind of nationalism movement in those different places, but I think decentralization captures both of those components.
So Middle East, oil prices actually topped $40 a barrel for the first time in 3 months, marking a 102% rally since the April low. But oil is still 40% below its price at the end of 2019. Your thoughts?
That's always an issue. There's actually a theory called heartland theory, where you have maritime versus the Silk Road. And that's why, based on this theory, there's always a lot of political unrest in the Middle East because it's the land bridge between China and Europe. So there continues to be a lot of turmoil. We still favor a maritime shipping economy. China's trying to change that with the One Belt, One Road system to connect that large, massive continent as one trading partner, where trading over land would surpass the maritime trading and really would shift trade power from the U.S., which is the dominant sea power, and towards the Eurasia continent. So
now the One Belt and Road Initiative, Russia's part of that as well.
There are many players in it, and if you just go back in history and look at the Silk Road, it's not a coincidence that those that have participated in the Silk Road are the areas that are looking at this, because it would shift economic power back to those regions. So if you want to know why Israel and Afghanistan constantly have political unrest, is because look at where they're located. To get to India and China, you have to go through Afghanistan. There's just a couple of passes to get into those two countries or two land masses, and they historically have been major wealth centers. But if you look at Israel, you would have had to go through Israel to either go to Egypt or get into Turkey to get to the Silk Road and into Europe. So those two are really bottlenecks. So we can just see that. So
yeah.
It's not surprising to see these movements there from an economic standpoint.
Major initiative that's been going on. Now you mentioned the dollar maybe losing ground to foreign currencies, at least it had last
right.
week. how might this change our outlook on allocation tilts between U.S. and international equities, should that persist?
And so we would likely want to reduce our U.S. domestic exposure, and mid-cap would probably be the area that we would move the most away from. U.S. large cap tend to have a decent amount of revenue already overseas, and then small cap can benefit because that the U.S. dollars have less competition, so then there will be more domestic sales as those dollars would flow back into the economy. If we were to see that, we do think we would, one, increase some international exposure, reduce mid-cap, increase small cap, and depending on if there is price inflation, we'd look at commodities, and there likely would be, because if the dollar is dropping in price, that usually means that oil is moving up in price, and oil is a substantial percentage in most commodity indexes.
Now, you also mentioned that despite the economic downturn, disposable income went up. So once unemployment benefits expire, what impact would you expect on that disposable income as people re-enter the workforce?
With some of the income increase is likely due to the generous benefits for unemployment. And then on top of that, they're not spending as much because you just don't have as much opportunity. We do think there will be some bidding up of wages, especially if you're trying to compete with unemployment benefits while they're still out there. So we see this as money that will be spent in the future. It's because we've kind of saved it, and it's really not been saving because people are wanting to tighten their belts and not spend the money. It's just a lack of opportunity to spend the money.
So economic data keeps getting worse. I mean, we had COVID, we had the shutdown, now we have the riots, or the looting, or whatever we call it.
The economic data, I wouldn't say is getting worse. We are seeing it increase. Now we've had 1, 2, 3 punches. This is once again, the worry is there. But if you're driving coming into work, I see a lot more traffic. We're right next to the interstate. We see a lot more traffic.
I guess it seems like the economic data, but it's probably the economic news seems getting worse because there's a lot of things going on.
It is exhausting.
The stock market keeps going higher. I mean, even today we had a nice rise in the S&P and the U.S. indices. But so now we're seeing more economic destruction from businesses being damaged or destroyed from looters. I know you keep pointing to monetary and fiscal policy as the reason for the market moving higher, but how bad does the economic damage have to be before these policies don't actually work or help?
There was a saying coming out of 2008, which is bad news is good news, and at least for the stock market. The reason is if we were to see a downward movement, economic data continue to deteriorate, there's going to be another stimulus bill. There's going to be the Federal Reserve acting and increasing the money supply. So as long as that is the current philosophy of the Federal Reserve Board, where they believe that the best thing to do is to just be very, very accommodative, we don't see the chance of a prolonged sell-off in the market. That does not mean that we can't have some shocks, but the Fed would act and would just continue to expand their balance sheet. So ultimately, we are very concerned about the amount of debt because it eventually ends up as debt for the U.S. government when we do this, and the chance of inflation. Because if the economy is not producing and we're increasing the money supply, well, you have more dollars chasing fewer goods, you would see the price begin to go up.
Right, I have one last question. I love the way that you distinguish in your presentation between the record number of protesters who are simply exercising their constitutional right to stand up and speak out from those who choose to loot and destroy business and property. You know, Larry Fink, chairman and CEO of BlackRock, sent his staff an email over the weekend which questions BlackRock's own internal dynamics. It says, as a firm committed to racial equality, we must also consider where racial disparity exists in our own organizations and not tolerate our shortcomings. So given that concept of corporate citizenship. This is something that we hear in economics and in our markets. How do you think businesses will respond to this outcry for racial equality or this racial disparity as Fink describes?
If we go years ago, whenever it first started to come up where there would be a black person killed by law enforcement, there were often arguments and debates and defending the police officer. If you take away the riots, it seemed like the reaction by the American people was unanimous that this was abuse and systemic and needed to be solved. So I don't think it's just the corporations. I think it's whenever we're looking at the overall society. My fear is the riots can actually cause us to not be united in where we have an opportunity where it seems that the entire society sees a problem and wants to solve that problem. What I hope doesn't happen is some of the rioting color the perception and start causing an us versus them mentality that does not allow us to take advantage of an opportunity of unification across the country to try to solve a problem that has been here for a long time.
I just think it's interesting how you get somebody, here's a CEO of a major company, right, who's recognizing and acknowledging that these are things
and I think
they're even as a corporate citizen need to address.
And I think that's because
everybody's
it's a recognizing what the situation that we're in as an entire community. It's not just corporations. So corporations are part of that community, and I think they're recognizing that.
Well, Aaron, once again, we are out of time. Boy, this sure goes fast because when I'm asking the questions, your answers are so spectacular. I hardly know what to do. But I must say, 2020 has given us plenty to discuss each week.
Yes.
So,
what I want to know is what happened to the murder hornets? They were here for like a minute.
I'm not sure, but I'm glad that it does give us good stuff to talk about each week. But so I want to remind that we are praying for our nation, that it heals quickly from this racial wound that's been highlighted by the injustice done to George Floyd. We also recognize and thank the many good police, women and men who risk their lives every day to keep our community safe. And while we grapple with heightened emotions from this event, COVID remains a significant risk too, to the many who have compromised immunity and other health impairments. And we also face re-employing all those who are sidelines from the workforce over the last few months. That's another challenge that we face. But here's the good news. The good news is that the market is a forward-looking indicator. So based on its reaction so far, this points to a better economy ahead. I think that's the good news in all of this. So while there might be bad news, I think that we can be confident that we have a better economic future ahead. So I want to remind all of our listeners that these weekly broadcasts are open to the public. We welcome the opportunity for you to share the links to our broadcast on social media or your friends and family, as they are more than welcome to listen in and learn our perspective on the market and the economy. And as mentioned last week, we also hope you'll sign up for our Gatewood Wealth Solution YouTube channel, where we're posting the broadcasts once they're approved by LPL. So thanks again for listening in to today's broadcast. And as always, if you have any questions, please contact your lead advisor or any member of our team. We are here for you. So long for now.